Dobro utro ut Luxembourg. Good morning from Luxembourg. I could have done this presentation in Bulgarian, but I know we have an international audience, so I'll do it in English in order to be inclusive for all the participants in this wonderful conference. Thank you very much for inviting me and to be part of this event, which I think is excellent and has a fantastic program. And I'm very happy that the ESM is now part of it. Let me start with my presentation and the key messages. The euro as a currency is 25 years old, and it has been a great success. The euro area and the euro have weathered the euro crisis and the pandemic quite well. It resulted in a stronger financial and banking architecture. And globally, we have a much stronger safety net these days. ESM, which many of you probably don't know, is the world's largest regional financial arrangement. And since 2010, we have 4 countries that joined the euro area, and Croatia joined this year in January. There are great benefits of adopting the euro, and I'll share some of those. And in a more volatile world, the euro area is much stronger and much more resilient. Now let me start with a little bit of history. The euro started in 1999, as we can see on the chart. And in the first 10 years, there were barely spreads between the countries. So all countries were paying pretty much the same in capital markets. This changed during the global financial crisis and afterwards in the sovereign debt crisis. Europe had to act extremely fast. ECB and Mario Draghi had the whatever it takes moment, and the ESM and EFSF, both institutions that we are managing, borrowed 300 billion in the market in order to support 5 countries that were in financial difficulty. We see that for those countries that spreads have come down. Greece, Ireland, Portugal, Spain, they are doing extremely well. And what we have seen during the next crisis, the pandemic, that these spread levels remained extremely tight. There, we acted extremely fast, again with a coordinated monetary and fiscal response. And ESM was part of the first response to the pandemic with a 240 billion credit line to the 19 countries of the Eurozone in case they would face difficulties that they could always tap that credit line. Now, ESM is part of this wider new European financial architecture that we created basically since 2010. We had the European Central Bank, which you see fully on the right as the monetary policy institution. We have a growth and investment facility with the European Investment Bank, but during the pandemic we added the European Commission with the Next Generation EU and the SURE program. We built the ESM, which is the Euro Area Rescue Fund, and with the new treaty, the ESM will be the backstop to the Single Resolution Board and Single Resolution Fund. And we also, during the last 10 years, built a very strong supervision with the European Central Bank for banks, and then EBA, ESMA, and EIOPA for the different industries that are part of the financial and capital markets. Now, ESM is not acting alone. We are part of a global safety net. Again, a little bit of history. If you look at the time before the great financial crisis, the IMF was the global financial backstop for financial stability. And then, when 2008 happened, it was not big enough to handle a crisis like the euro crisis. So we had to build over time bilateral swap lines, which you see here in yellow, and also regional safety nets like the ESM in Europe, in order to create a much bigger buffer in case of financial instability. And now, if you look at the entire globe, which you see on this chart, we have safety nets around the world. The ESM, with 500 billion euro, is by far the largest of those and is covering the euro area. And if you look in Latin America, we have FLAR, and also in Asia, AMRO and Chiang Mai Initiative, which combined have around 240 billion in order to create a safety net in that region. Now, over the years, the euro has become more and more popular. I mentioned that in the last years, since 2010, we had 4 countries join the euro area: Estonia, Latvia, Lithuania, and this year, Croatia. We spent this year a lot of time with Croatia to help them join the euro and support them, also join the ESM as our 20th member. And they have seen it as a great benefit of joining the euro as a currency and becoming a member of the European Stability Mechanism. Now let me start with market appreciations. Why is it good to join the euro area? You see here on the yellow line is the Croatian 10-year bond yields versus German bond yields. And you see that they were around 350 basis points or 3.5% in 2015. That was quite a large spread. And over time, we have seen that spread close and close and close to some of its already existing euro area peers, Slovenia, Slovakia, and Lithuania. Why is that the case? The anticipation of a country to join the euro was seen as market positive. And Croatia did a phenomenal job in its monetary and fiscal policy. And this has paid off and is appreciated by market participants. Now, there are more advantages to joining the euro. And I'll give you Croatia as an example. And you see at the bottom of the chart also a link to a blog that we wrote, which you can go even more deeper if you're interested. But countries become wealthier upon convergence to the euro area. When they start meeting convergence criteria, they see rating upgrades by rating agencies. Their euro-denominated debt is no longer seen as foreign debt, but seen as national debt and local debt by rating agencies, which is market positive. You join the second largest reserve currency globally, which enhances investor base, market access, potential lower funding costs. And I've seen that as the CFO of the ESM. I travel around the world, and investors really appreciate being part of the euro and investing in euros as the second currency after the US dollar. So if you join that currency, you're seen as joining a strong club of investors that are available, but also issuers. It increases investment inflows for the local economy. Because if a global investor knows that the country is euro-denominated, they have a lot of certainty in how to trade, how to invest, and how to be part of growing an economy. Payments are becoming easier and cheaper because it removes transaction costs, which often happens if you have different currencies. And it also gives you voting power in the ECB and in the Eurogroup, but also in the ESM Board of Governors. And finally, you have access to the Euro Area Crisis Management Framework, and ESM is part of that. So that means that countries, if they were to get in difficulty, they would always be able to access the European Stability Mechanism and our 500 billion capacity that is there to create financial stability. Now, let me turn to Bulgaria. Bulgaria has been outperforming both higher and similar rated non-euro area peers. And Bulgaria is here in the blue line compared to Czech Republic in yellow, Hungary and Poland in brown. Bulgaria is BBB rated, but has been doing extremely well in capital markets, as we can see here. And it contracted its spreads and performed well. This is a sign of appreciation by the market on the fiscal side, monetary side of Bulgaria, and the anticipation of being part of the euro, which the market is seeing as something very positive. Now, if I compare Bulgaria with its euro area peers, Croatia, Latvia, and Slovakia, we see the blue line over here, again, Bulgaria. The red line, also BBB rated, is Croatia, and then Latvia and Slovakia. We've seen also here that Bulgaria is closing its spread levels towards its euro area peers. And the initially almost 200 basis point gap in 2016 is now coming down. And despite the similar rating of Croatia, they're moving closer and closer together. So there is an appreciation of the market towards Bulgaria, which is positive. Now let me turn a little bit to the future. And the organizers of this conference gave me a task to end this presentation with a bit of an outward look. What can we expect from the coming years? Tell us your CFO view, tell us your ESM view. In October this year, we had the IMF and World Bank annual meetings in Marrakesh. And I also will bring in some of the latest development in the last month, for example, our trip, a roadshow to China last week, but also visits of other Euro area member states. Geopolitics is on the top of the agenda, with conflicts in the Middle East, in Europe, in Africa, and other parts of the world. We see higher for longer interest rates. If you look a few years ago, the idea was low for long, so negative or low interest rates for a long period of time. If you now look at market appreciation, central bank communication, IMF communication, is that higher for longer will stay with us, especially because inflation is more difficult to bring down. There's a monetary and fiscal policy mismatch. So although monetary policy has become more restrictive, we see fiscal policy still being loose in some parts of the world, which makes it more difficult in order to reduce inflation levels, and coordinated monetary and fiscal policy is always better than a mismatched monetary and fiscal policy. We see political and electoral uncertainty in countries, and one of the latest was 2 weeks ago, the elections in the Netherlands, where we've seen a very strong move to the right, where 2/3 of the voters and electorate voted right-wing parties. So that is a sign where the population is giving an indication in European democracies in which direction they want to head. Next year, we have more than 1 billion people going to vote. This is in Europe, in India, in the United States, and other parts of the world. We will see more innovation in the markets. We've seen fintech moving into the space of capital markets, and now artificial intelligence. As CFOs, banking community, we need to stay on top of this. And for those of you that follow the World Economic Forum and Davos meetings in January, will be very much about artificial intelligence and the future. And finally, environmental, social, and governance agenda, ESG, will need refocusing. It went through a tremendous boom. And for those of you that were not aware, 2008, the European Investment Bank launched its first green bond. In the first 4 or 5 years, it was not such a big capital market activity. But now it is a very heavy and a strong market that has been well developed. And we as ESM are investing in that space also ourselves with our own paid-in capital. In the last 2 years, we've seen a little bit of a reduction in this market. But it is a market to stay, because if you want to finance climate change and improve the world for the next generation, it is a must. And while this conference takes place, we have COP28 in Dubai, which shows the importance of this agenda item. Now, those 6 things to watch for 2024, you can read at the bottom, as you can see, in a blog that we launched in October. So for those of you that are interested, please feel free to read it. But I want to leave you with one, and maybe the most important message that I have for the audience. Over the last 10 years, we have built a much stronger and much more resilient euro area, which is far better crisis-prone for the future. The euro area is much more integrated, and the ESM, my institution, is a core part of that architecture. I want to thank you all for listening to me and being part of this conference. Благодаря много за всички, че сте тук, и благодаря за организацията на тази прекрасна конференция. Много поздрави от Люксембург. See you soon. Goodbye. Thank you.